everyone. Welcome to another Low Key College Convo. I'm your host, Dr. Kim McCurdy. And today we're here with William Lindsey. Will is the Senior Vice President of Federal Relations and Outreach here at PHEAA, the Pennsylvania Higher Education Assistance Agency. He promotes PHEAA's mission to create affordable access to college for students and promotes our programs, products, and services to institutions, legislative and civic groups, and to our customers across Pennsylvania and beyond. He joined PHEAA in 2003 and has had several roles, including being my manager at one time. And he did begin his current role in 2023. He holds a degree from Clarion University and an MBA from the University of Phoenix. So welcome, Will, to the podcast.
Well, it's certainly exciting to be here. Kim, thanks for having me. Lots to discuss.
Yes.
Lots of moving parts within the higher education landscape. And I think today we'll drill down on some of the changes, the impact this has to both institutions, students, and many of the audiences that we support. So I think this is good timing in terms of the conversation, and certainly looking forward to it.
Yes, and before we get into all of things OB3, as we affectionately like to call it, I do like to start my podcast by talking about the tapestry of your education and your career and kind of how you ended up in this seat and why you have a passion for this work.
Wow, that could probably be its own podcast. Be its own podcast. But going back, so you mentioned I did graduate from Clarion, and prior to that, I think I had an interest in secondary teaching. Believe it or not, and this is probably new for many, I did grow up in France. I moved to France when I was 6 months old, came back as a junior in high school, and so wanted to teach French, and probably through my junior year in college decided, not sure if I wanted to teach, but wanted to become an interpreter or even a translator. Graduated, tried to get jobs in that field for the United Nations, didn't pan out, and got into the higher education space. Worked for a local college here, Central Penn College, worked in admissions and financial aid. And then I think from that point on, I knew there was a calling there. And really, the calling, and it's still aligned with the work that we do today, is access to higher education. Working with students, making sure that they know of what opportunities are available to them. And that's been a passion from day one, continues to be, and so glad I still have kind of an arm or a leg in that space with the outreach that we do currently today.
Right. And you either stay in it for 3 years or 30, so you're approaching.
I'm there.
So you're in it. And so today we're going to talk about the One Big Beautiful Bill Act, and there is so much noise in this space. I know just from a professional perspective, there are trainings galore that folks can attend, but I also want to touch today on the parent and student aspects, because I don't know, there have been things in the news, but I don't know if parents and students are aware of all of the implications of some of these things. So can you talk to us about what is the One Big Beautiful Bill Act, or OB3 or OBBBA, and why parents and students and schools should pay attention to what's happening and how this is going to affect higher education for them?
Sure, and just to clarify, and we'll peel the onion a little bit, so this was signed by the President July 4th of 2025 as the Working Families Tax Cut Act, okay? And it spans beyond higher education, right? There were other cuts within this bill, but specific to the landscape that we're in, it really restructures, and there's some drastic changes to student loan borrowing limits that students can have, but also on the back end in terms of repayment. So for existing students that are currently in a repayment, some of the changes that are here, and I know we're going to drill down a little bit, but I think, and to your point, when students and families, what we need to do, and again, this is part of the work that we do, and the work that you do, is outreach, right? Making sure that there's a trusted source of information, and I know you've got a lot of resources from your NASFAA colleagues and what NASFAA's offering, but making sure that families, students are at least aware of the changes, how it's going to impact their shape of higher education, or can it change the decision making that they're going to make as they're pursuing those opportunities.
Right. And we should mention PHEAA has has a page, PHEAA.org/OB3. NASFAA also has information. So if you're a student or a parent or at a school, there are lots of online resources, and we're going to talk about some of the things that are available, but we will have all of the links in the meeting notes today for you as well. So let's jump into the undergraduate changes, specifically PLUS loan. So talk to us about what is a PLUS loan and what are the caps and how is that going to affect parents who really rely on that loan for borrowing.
Sure. And before we jump into that, I just had another thought in terms of how schools can prepare for that. This is where I feel that the financial aid is a very strong community.
Yes.
So attending conferences.
Yes.
Attending sector meetings, calling one another is going to be another great source, right, of resource to be able to get the information. So going back to PLUS, and I just want to be mindful of the audience. So a PLUS loan is essentially a loan that a parent borrower could borrow on behalf of their dependent student. And jokingly, and I know when we work together, we always shared with parents that this is a parent loan.
Right.
It's not a student loan. It's in the parent's loan.
You can't transfer it to your student.
Absolutely. And believe it or not, you had many conversations with parents on that back end. So essentially, there's some changes that are taking place with the Parent Plus loan, where now they're instituting caps. In the past, you could borrow up to the cost of attendance. Now they're putting caps, annual caps of $20,000, and then there's an aggregate cap of $65,000. The other, I think, important point to mention is that this cap is per dependent student. Okay, so if a parent has multiple children, they would be able to borrow that $20,000 annually for each of those students or dependent students, but not more. If a parent wants to borrow 20 for that student, it's really at the dependent level student.
Right. So if there is a mom and a dad, each parent can't borrow $20,000. It's total for that
particular student.
Okay. So, and you mentioned the $65K cap. So if I need $20,000 in PLUS for year 1, 2, and 3, and maybe I even have to go for year 5, I'm going to be short.
There could be an opportunity for you to be short. So this is where, again, the awareness is key.
Right.
As you're planning, because when you talk to parents, oftentimes they just worry about year 1.
That's right.
Right? So look at the longevity, map out what that looks like on the back end so that you have a plan in place.
Right.
I think the other portion of the discussion too, Kim, and let me know if it's appropriate to talk about it now, is comparing whether PLUS is the right option, right? And then we can talk a little bit more in detail. Now, another point to make with the PLUS loan changes, these are going to become effective July 1 of 2026. Right? There's a grandfathering provision as well that's key, so that if a student or a parent has borrowed under the prior provisions, they'll have access to the full direct cost of attendance difference that they have, so long as the student is enrolled for 3 years in that program and doesn't change or graduates within that time frame. So they'll still have access to that, so long as they had loans prior to July 1 of 2026.
And that expires in 28?
28, correct.
Okay, so we have a little bit of time. There are very few parent borrowers, I think, in something called public service loan forgiveness. Can you talk to us about the provision that has been implemented for parent borrowers who are enrolled in PSLF, and you can talk about maybe briefly what that is, and if they were to take new PLUS loans, what that does to them?
Yeah, so again, another key focus of awareness that many may not be aware of, but the Public Service Loan Forgiveness Program is an opportunity to have portions of loans essentially forgiven if you meet certain commitments, right? So there's a work commitment, you have to have the right loans, and you have to make so many on-time payments, and you have to have the right repayment plan to be eligible for that. So with some of the new changes for PLUS, in the past, and the other, I think, point to make that's equally as important is the parent borrower, even though they're borrowing for their child or their dependent student, has to be eligible for their own public service loan forgiveness. So they have to work for the right employer. It's not the student or the dependent, right?
Right.
And you know
that would be like government agencies, nonprofits.
Correct.
Yep.
With the new changes, in the past, income contingent, ICR, was a repayment plan that a parent would be eligible for. They would have to consolidate and then pursue an income contingent repayment plan. With the new repayment plan starting July 1, if a parent borrower takes out a loan, they're automatically going to be put for that in the tiered standard repayment plan, which is not an eligible repayment plan for forgiveness. So the other catch there too is, I think, strong consideration. If a parent wasn't in an eligible repayment plan in the past and had made payments and takes out new Parent Plus loans moving forward and are put in that tiered plan, those past payments wouldn't count anyway. So I think there's going to be a lot of discussion, education that needs to happen collectively from us, from institutions, from servicers too, that are going to have to explain that to borrowers as they move forward with that process.
So I think the best course for a parent is, if you have borrowed plus loans and you know about public service loan forgiveness and you think you might be enrolled, you need to do some due diligence and some research.
And determine whether plus is the right solution moving forward. Because if you already are qualifying and have made payments, you don't want to lose out depending on how far you are, So each situation is going to be somewhat unique.
That's right.
In how you counsel a student or a parent. But yes, having that discussion, mapping it out, and seeing what the overall impact would be.
That's good advice. Let's talk a little bit about graduate students now. So graduate students are eligible for direct student loans. We always tell families you should obviously look at those direct loans first. And so grad students can borrow $20,500 in direct loans, but we know there are graduate programs that are more expensive than that, and they've been relying on something called Grad Plus. And that program is going to be eliminated.
And I think that's the why, right? So to your point, you talked about some of the amounts for graduate students. Effective July 1, the Grad Plus program is completely being eliminated. Meaning that, for new borrowers, starting July 1, 2026, there's a grandfathering provision that if you borrowed prior, you would be able to borrow at those limits, right? I think the key thing here is, again, understanding those caps. So for a graduate student, there's a cap of $20,500 annually with an aggregate total of $100,000. And then there's a second layer for under the graduate kind of promotion of professional students, where those loans are capped at $50,000 annually with an aggregate of $200,000. So,
and it's only particular programs. Folks should look at the federal student aid site to see which programs.
And there's 11 programs that fit within that definition. The other key thing is maybe understanding the why. So in the past, and if you look at the legislation, there is a definition of what a professional student is, right? But with the Grad Plus, there was no distinction in the past, right? So it was kind of all within that they could all borrow. Now they've defined and kind of carved out, my apologies, a graduate student versus a professional, thus those limits. And then, if you want to talk about aggregate limits too, there is an aggregate limit that they can overall borrow, and that's what an aggregate limit is. They can overall borrow up to $257,500. There are a few exceptions. And then recently, the Department of Education did provide guidance that Graduate Plus loans are included in that new lifetime borrowing. Correct.
And so for students who maybe aren't classified as a professional student any longer and they can't get Grad Plus, what do they do?
So again, there's alternatives out there, right, to look at. And this is where you can rely and research state-based opportunities such as PHEAA, PA Forward, or the Keystone Loan Program to see where they have. And again, these are gap opportunities, right? Our hierarchy of options and how we counsel students and families, free money first, so really try to exhaust scholarships, and then, I think defining and researching what's the best option for you, and there's loan programs that we have, and probably this is a good opportunity, maybe Kim, to talk about the health and some of the medical programs that we're looking to implement.
So I do want to mention that we have recently launched our graduate professional student loan. We also have a medical student loan. So medical, there's maybe 5 programs that qualify, MDs, DOs, I think podiatrists are in there. But then there's a whole other side of our new loan, the grad professional loan, and those are things like optometrists and psychologists and folks that are going to need some additional training, some additional access to funding. And then we also are going to work with them in things like residency and make sure that we help them with their repayment. But the best news about this is, alternative loans, you have to have good credit. And a lot of times, if you're a student, you really don't have a lot of credit history, and so you needed a cosigner. And so for these particular loans, we're really excited that we are going to be using future earnings as one of the kind of metrics that we could. You potentially wouldn't need a cosigner then to have this loan. So I think it'll be a little bit easier. I know we're seeing in the news maybe something like 50% of borrowers aren't going to qualify for alternative loans. And so we're really trying to make sure that, we give folks the opportunity to complete and finish those degrees. So really excited that has launched, and we're going to have a webinar coming up about that, and I'm going to talk about webinars in a little bit. But just a really good opportunity for families, and we're trying to meet the needs from this new legislation and
there's going
be
to be
responsive
a need with this,
That's
right? And the other thing too, this is supplemental to the other programs we're still offering.
That's
correct?
right. That's right.
Yeah.
So we do have the PA Forward student loan program, and that is for students who are in Pennsylvania, who are traveling or who are attending school in Pennsylvania or anywhere else in the country. They can borrow a PA Forward student loan. These are low interest rate loans. They're fixed interest. Usually an undergraduate student does need a credit-worthy cosigner, but they can borrow cost of attendance minus any other financial aid, and they can qualify for this. We offer a 5, 10, 15-year repayment program, and there's just, it's a really good opportunity. We were able to secure some low-interest bonds, and so we're able to offer those benefits as a state program to our learners. But then we also have something called the Keystone student loan program, and this is for our students who are in our border states that are coming anywhere except Pennsylvania, so they're attending anywhere in the country, and Virginia, so it's the border states and Virginia, and they have the opportunity to utilize the Keystone student loan program, which is also a low interest fixed rate loan. Again, might need a credit-worthy cosigner if they're an undergraduate student, but we're able to meet the needs of some of these changes that are coming down the pike for our families so that they can still have access and make it more affordable.
No, that's good. And Kim, and maybe just one, test my memory just for our audience. So those border states, I try to memorize them. So keep me honest here. Delaware?
Yes.
Maryland?
Yes.
New York?
Yes.
New Jersey?
Yes.
Virginia?
Yes.
West Virginia?
Yes.
And Ohio?
Yes.
Okay. See,
Very good.
I'm working on it.
Yep. I had to kind of go around there. I usually start in Ohio and I work my way around, but yeah. So those are the states. So if you're in one of those states, if you come to Pennsylvania from one of those states, you still borrow a PA Forward loan. But if you go anywhere else in the country, you would be borrowing Keystone. And again, we'll have all these links to access in the meeting notes, so you'll have that. So now I want to talk about. Sorry, I lost my spot.
No, well, I think if appropriate, one of the things, since we talk about our loan program, how does it compete against the PLUS loan, right? And that's a good opportunity as we're talking to families, students, and even institutions of some of the benefits of a state-based loan program such as PA Forward or the Keystone Loan Program, and at which point do we compare it to the PLUS, but what's the hierarchy of options that we typically go through, right?
Yeah, so we, again, always free money first. You want to get all of your grants and scholarships and any money that the institution will offer you first. And then we do ask students to take a look at those federal direct loans. So that $5,500 for the first year that they're eligible for, there's an unsubsidized portion and a subsidized portion, and we want them to take a look at that first. And then if there are gaps, if parents are willing to borrow, they could look at the PLUS loan, but we also would urge them to take a look at our PA Forward loan product for our parent loan. And the reason is we don't have any fees on our loan, and the feds, it's a 4-point-something%
and those
fee.
Are called origination fee.
So we don't have any fees, and then the interest on the federal PLUS loan is like 8 something, and our average is like 6.5% to 7% for our interest. Wow. So, and then if you pick a 5-year repayment plan, we'll give you a reduction on your interest. So there's some perks, and then we offer some back-end benefits as well. So 0.25% if you decide to do auto debit when you go into repayment and things like that. So there are definitely benefits to shopping around and planning and learning, like, how might I finance and what works best for my family. So again, every situation is different, and for folks who don't have good credit, sometimes Plus might be a better option. Right. They don't look at any debt to income. So if you don't have any adverse credit, usually you can get that loan. Now, whether you can afford the loan is something that you'll want to consider as well.
I think we consider ability to repay.
That's
overall,
right.
Right. Yeah.
That's right.
Meet Keystone Student Loans, your key to help pay for college. Access great benefits such as competitive rates, no fees, and multiple repayment options. Plus, you can finance up to 100% of your school certified cost of attendance.
So there's a couple of other things in OB3. One is called loan reduction, and I wanted you to touch on that because I know there's a lot of talk in the financial aid community. There have been webinars in our professional organizations about it, but I don't know if families are aware of this particular
Yeah, so
part.
I think when you say loan reduction, I would take that as the loan proration for part-time students,
right.
I think is my assumption. And so that is one of the drastic changes that's taken place where essentially it's a new rule that would help reduce loan amounts for students that are enrolled less than full-time. So essentially, I think the key thing there is understanding from a student's perspective the impact that has and whether or not that changes their ability. So when you think of part-time students, and maybe this is a blanket statement or a general kind of assumption, but part-time students, you're typically looking at non-traditional students, most likely, right? That are working, that have a family and so forth. So that's going to change because sometimes they use some of the refunds that they may have for travel expenses and other things, right? So what's going to happen now is there's going to be annual loan limits that are really going to be scaled down based on proration of what they're borrowing based on their status, right? So if I were to counsel a family, make sure you talk to your financial aid office, right, to understand what that means and does that change your trajectory in terms of time frame, the impact, the overall impact that it may have in you wanting to be a part-time student. Right. And not to mention, I think the burden and impact it has on institutions now because it's going to be formally driven in creating what those would look like, right, moving forward.
Yeah, so if you are a family, definitely look and talk to your financial aid office so that you know what the implications are for going part-time. And if you're at an institution implementing these changes, there are so many webinars happening right now and resources through NASFAA, ESFA, other financial aid organizations. So definitely hop on some of those. I know there was an ESFA Tuesdays at 2 last week that did a really good job of explaining some of this stuff. So definitely look at those. And again, call your friends.
Yeah, I think that, this is where the financial aid community is strong as a whole.
Yes.
Rely on some of your colleagues, right? Because, and I'm not sure if the same for you, Kim, but anytime I join a webinar or listen, I pick up a few new things.
Oh, sure.
Either it's the way that the presenter is
explaining it,
saying it, that I always walk away with something new. And again, this is a change that's going to be effective July 1 of 2026.
Right. And then we briefly mentioned loan repayment plan changes, and essentially there are plans going away and some new plans in place. So if a student is currently in repayment, what do they need to know?
So if they're currently in repayment, essentially there's a sunset timeline. So meaning if they're currently in repayment, and there's different layers to that. And the reason I say that is and maybe I'll talk to it first before I forget. So those that are in a SAVE income during repayment plan,
yes.
right? Recent court ruling essentially stated that the plan was unlawful. So the plan is essentially going away, and that impacts a little over 7 million borrowers, right? My understanding is that the Department of Education has reached out to borrowers, stating that they're going to restart receiving communication from their servicer, and I believe starting July 1, and at that point they're going to have 90 days to make a decision and select a new repayment plan, including the new repayment plan. So the new tiered standard, and then there's a RAP, which is the repayment assistance plan. And they'll have 90 days to select. If they don't choose a repayment plan, they're automatically going to be put into the tiered standard repayment plan. For other borrowers that are, let's say, in the income contingent repayment plan or another repayment plan, they'll have until July 1 of 2028 to get off of that repayment plan and take advantage of one of the new repayment plans, or even IBR, income-based repayment plan, is still one of the eligible repayment plans because it was, approved through a different congressional process a while back.
Okay. So again, if borrowers have questions, contact your servicer, contact the institution that you attended. They might be able to help you as well.
And visit studentaid.gov. They're providing updates, and I think they recently updated a lot of their questions and answers. So again, take advantage of those resources. Reach out to one of us. The good news here at PHEAA, I always share, is if I don't know the answer, we've got 900 other people within the building that can get us an answer.
We'll figure it out.
But yeah, there's the two new repayment plans, tiered standard. It's going to offer 4 payment plans essentially based on the amount borrowed, right? So if a borrower is borrowing less than $25,000, they'll be on a 10-year repayment plan. If they're borrowing between $25,000 and $49,999, they'll be on a 15-year term. If they're borrowing $50K through $99,999, they'll be on a 20-year plan. And then for anybody borrowing more than $100K, they'll be on a 25-year repayment plan. And similar to the current standard plan, there'll be a minimum payment of $50.
Okay. And there's never any penalty for prepayment either.
No,
that's just because you're in a 25-year plan, you might not want to stay there for 25 years.
In particular, if you can parse it out that you can pay it off early. Obviously, and here's the other conversation, and I know you probably recall, is we always encourage students, while they're in school, if you can, make interest payments or small payments so that, it doesn't capitalize and it's a much lower. So develop good habits. So if they can do that, that would be terrific. And then the second repayment plan that you inquired about is the repayment assistance plan, and that's the new income during repayment plan. And so that payment is basically going to be adjusted based on income and family size. So the higher the income, the likelihood the higher the monthly payment. The lower income, the lower the monthly payment plan. And the difference here from prior repayment plans is that the minimum monthly payment, you'll still have a $10 minimum, right? That's the lowest. In the past, you could have an income during repayment plan where you had a $0 payment.
That's right. Okay. So for parents and families, resources online, there are, NASFAA has some really good checklists and things that kind of explain all of the changes if you're a new parent borrower, if you're a current parent borrower. So I want to make sure that folks are aware of these. If you're at an institution, there is an implementation checklist at NASFAA.org as well. And for parents, if you're looking at alternative loans, there are checklists to see these are the things that you need to look at if you're going to consider borrowing a parent loan, and then see which lenders check all of those boxes for you. So you want to make sure you don't fall prey to any kind of predatory lending or scams that are out there. Remember, you shouldn't have to pay money to get through any of this process. There are a lot of people to help, and PHEAA can help as well. So our information is online, and we're happy to, and we have 13 access partners.
That's the point I was going to put in, so you're already ahead of that, that's the work that we do, right? It's tied to our mission, which is providing affordable access to higher education. Take advantage of that. The good news is they're very active in keeping up to date with all of the changes. Reach out to them. To your point, on our website, they're strategically located in the counties that they serve. So if you're a high school student, non-traditional student, any type of organization that supports students, find them, look at the county, reach out to them. We host a number of webinars, different topics. We also host financial aid counselor workshops in the fall, where we provide a lot of updates. So if you are a counselor or an educator, so there's plenty of resources. And I think the other good news is, you know, we're a trusted resource. We're making sure that our website stays up to date. We're updating as quickly as we can, right, with the changes that are coming. So I think the resources are plentiful, and same with your team, right, in terms of, you know, you're a good resource, and as you mentioned early on, you did work in this space. So you do have that expertise and that background.
Right, and we're a lender, but we also have a lot of resources that don't have anything to do with borrowing, so take advantage of all of those. We do, for Keystone, we have some upcoming webinars. We just had the Borrowing for Higher Education presentation, and that will be available on our website shortly. We also have something coming up called Deep Dive into Paying for Higher Ed, and something called Improving Credit. So that's one, especially if you're not looking to borrow maybe this year, but you have students coming up and you might need to borrow. This might be something to take a look at to make sure that you're ready to do that. There are some other things about accountability, student tuition and transparency. I think these are all really good things for families, but at the end of the day, I would just caution families, do your research, make sure that the programs that you're enrolling have good outcomes, that there's there are going to be jobs in those fields. You had mentioned something to me earlier about a FAFSA. There's information on the FAFSA for families even. Yeah.
So there's plenty of resources. So I think there's outcomes on how well schools are doing, and this is a new outcomes on the FAFSA summary page. So you can kind of look at that. We also have a couple resources, and you hit on how green a job may be in the future. Education Planner is a great website where we connect to My Next Move as well, where there's projected opportunities within specific fields. The other resource that, you know, if you don't mind me sharing, is mysmartborrowing.org, and that does exactly what you just shared. It allows you to compare cost of an institution based on the major and a career output, right? Again, high level, because every institution cost may differ based on that particular student, right? So that's why it's important that you work with the institution, you apply to see where you are, because there are instances where maybe a higher cost institution ends up being cheaper or lower than others, right?
And we've seen that,
and you've seen that. So have those conversations, but at a glance, it's supposed to help you say, okay, based on this career, this is what I'm going to make, and here's the institution cost if I'm comparing a couple institutions. At least that way you can kind of see where you're at and make an informed decision.
Anything else that we should discuss today?
No, just take advantage of the resources that are available to you. Again, I can't stress the fact that I think we're a trusted resource. Come to us. It's tied to our mission. The other thing, too, is, and if we have students and families listening, all of our resources are free. Right? And so beware of scams. There's a number of things that are happening out there, in particular with scholarships. You have to pay a fee. You shouldn't have to pay for scholarships. So take a look on PHEAA.org. You mentioned studentaid.gov is another resource. NASFAA for our colleagues that are in the higher education space. But I think overall, there's lots of changes. Just being sure that you are up to date with what's happening. And there's a lot of uncertainty, right, that's going to take place with students, schools, but I think we're all going to adjust to those changes.
And we adjust before. We've always adjusted. Things always change.
Correct.
It'll be all right.
It will be. I agree.
But I think for families, plan as much as you can. There is so much noise in the space, and so as much as we can be helpful to you, I really want to stress that you need to look into this. This isn't something that, you know, the 11th hour. My student's going to be going to college next month, and I have this bill and I don't know what to do with it. You really need to start a couple of years before that happens, I would say. Like even at 9th grade, even just starting to think about what is our aptitude to borrow for our student? What kind of resources have we saved? What else can we do in the meantime? So I think that that's really important.
No, I would second everything that you said. Planning is key. The sooner the better. And I think that's the other benefit of many of the resources that we offer here at PHEAA is we try to support our students and families throughout their entire journey. right? The upfront, making sure that they know what resources, and something as simple as knowing what forms to complete,
right,
when to complete them,
right,
what information you need, and what you can get out of completing that. Scholarships, and then being educated about how do I fill the gap? How do I compare what's best for me,
right,
through the support in school, and then on the back end, how can we better support students on the back end? And if it's okay, Kim, we're starting to do that too through legislation. We have our Repay Ready suite of products, which we're helping schools support their delinquency population, so that way it doesn't impact their cohort default rates or non-payment rate by institutions. Now that I think there's a real focus on, more school accountability and support with the outreach they're doing and making sure that their students are repaying their loans. So again, it's the entire journey, and I think we try to provide the right resources and support for all of the audiences that we support to make sure we get them through it.
Yep. So lots of information for families. If you're listening, please let us know how we can be useful to you. Thanks for coming on and talking about all of this. And as changes arise, we'll make sure that we keep everyone updated.
No, thanks for having me. This is great. And obviously, I think we've only touched on a little bit of the whole pie, and certainly happy to continue to have conversations. So thank you, Kim. Appreciate it.
Sounds great. All right. Thank you so much for listening, and we'll see you next time.